Hello and a warm welcome to you. I truly appreciate you taking the time to join me for this financial literacy masterclass. Whether we're connected through family, personally, professionally, or even just through social media, it generally means a lot for me to share the knowledge I've gained over the years to help others be aware and take action. Before we get into the how, I want to take a moment to share the why. Why this topic is so important to me personally. I want to talk to you about something we don't always think about in depth, and that's legacy. We all recognize well known families' names like the Rockefellers, the Vanderbilts, and the Hiltons, families whose wealth and impact has lasted for generations. But for most families, our stories and our own wealth don't last nearly as long. In many cases, everything rests after just a generation or two. So the question is, why? It's not because people didn't work hard. It's not because people don't care about their family. It's because for most families, no one ever passed down a financial blueprint. No one sat down with our parents, our grandparents, or great grandparents and showed them how to truly make money work for them. How to use tools like life insurance, not just for protection, a death benefit, but as a strategy to build wealth, access it during their lifetime, and pass it on. Because those conversations didn't happen, many families, including possibly our own, have had to start over again and again, generation after generation, trying to make it. And that's what really lit a fire in me. I realized that what we do in financial services is incredibly powerful. It gives us the ability to not only change our own financial future, but to change the trajectory of our own families for generations to come and to help others do the same. So, this is about more than just money, it's about protection, growth, and building a lasting legacy. And that's exactly what we're going to talk about today. So, the goal of this masterclass is simple: financial education. Because the reality is, most people were never taught how money really works. We learned math, science, and history in school, but very few of us were taught how to truly build wealth, how to properly protect our income, how retirement actually works, or how taxes impact the money we earn. So, what happens is a lot of hardworking people are doing the best that they can, but still feel uncertain about their financial future. So, my role as a financial consultant is to help bring clarity, to help you understand how money works so you can make informed and confident decisions on your own without having to ask people, what should I do? What should I do? You will already know. And I want to be very clear from the beginning. This is not about selling you anything. This is about giving you knowledge, options, and a better understanding so you can decide what's best for you and your family. This masterclass is going to be very powerful. So I encourage you now to get comfortable, eliminate any distractions, and maybe even grab a notebook so you can take a few notes along the way. Today, I'm going to walk you through some of the same concepts and strategies I use every day to help families protect their income, grow their money, and build a stronger financial future. So, with that, let's get started. All right, everyone. So, go ahead and take a look at my screen. The way my team and I can help families is through a variety of financial solutions. In the How We Help section, that includes things like life insurance, long-term care, 401k rollovers, Roth IRAs, rollovers, annuities, mortgage protection, borrow insurance, and strategies like infinite banking. And as you can see next to that, we work with multiple well-known companies. We're partnered with a financial marketing organization which allows us to represent many of the top insurance carriers across North America and Canada. Some of these names you may already recognize, like Forster's, Mutual Omaha, Transamerica, and others. These companies have been around for decades, some even over 100 years, and they have strong reputations in the industry. So, what we do is we shop from company to company to find the best solution based on each client's wants and needs. This is not a one size fit all approach. Now, out of the 7 ways we can help, I'm going to walk you through about 4 of these strategies in this masterclass today. I am going to start with life insurance because it's the easiest to understand, the quickest to explain, and honestly, it's one of the most needed. If you were to go on GoFundMe right now and type in funeral, you will see hundreds of thousands of campaigns. Now, that should tell us something. This is a conversation that hasn't been had enough, but it is well needed. So, my goal is to give you the right information so you can not only make better decisions for yourself, but also help spread awareness and change the narrative. Now, let's walk through a simple example. Let's say I have a 35-year-old woman who comes to me and says, Coretta, I want $500,000 of coverage to protect myself and my family. What are my options? So, when it comes to life insurance, she really has 3 main options, and I'm going to break each one down for you. So, the first option is term life insurance. Term simply means temporary. It's coverage for a specific period of time. So, let's say she gets $500,000 of coverage for 30 years. If something were to happen to her between ages 35 and 65, her family will receive that 500K. That's immediate financial protection, what I like to call instant legacy creation. Now, many policies today also include living benefits. So, if she were diagnosed with a chronic or terminal illness or even had a serious accident and couldn't perform daily activities, she could actually access that money while she's still alive for things like medical expenses, home modifications, and more. And the cost of this term policy is roughly around $50 a month. So the advantage of term is simple, it's very affordable. You can get a large amount of coverage for a low monthly cost. But the downside is it expires. At age 65, that coverage ends. And all the money she paid into that policy as well. It stays with the insurance company. So she loses the coverage and she doesn't get that money back. The second option is a return of premium policy or ROP. It works very similar to term, but with one major difference. If she passes away during that same 30-year period, her family still receives the $500,000. But if she outlives the policy, she gets all or most of her money back. Now, because of that added benefit, the cost is higher. Instead of $50 a month, she might be paying around $150 a month. So by age 65, she could receive a check for around $54,000, which represents the total premium she paid in this policy. And that's why it's called return of premium, ROP. So the benefit here is you either leave money behind for your family or you get your money back. The downside is it still expires. At age 65, she will need to reapply for coverage. And at that point, her rates will be higher, and depending on her health, she may not even qualify. This is why getting coverage while you're younger and healthier is so much important. And finally, the third option is permanent life insurance. If I were to compare these to cars, Term would be like a Toyota Corolla. ROP would be like a Lexus. And permanent, now that's your luxury vehicle because it does so much more. Permanent life insurance has three major benefits. First, it never expires as long as it's properly funded. Second, it includes living benefits so you can access money while you're alive if needed. And third, it builds cash value over time. Now, a lot of people think life insurance is only for when you pass away. But the truth is, it can also be used while you're living. So let me give you a quick real life example. I had a client who suffered stroke. Because of the policy he had in place with living benefits, the insurance company issued him a check for $130,000 while he was still in the hospital. That money helped him cover medical bills, continue paying his mortgage, and maintain stability during a very difficult time in his life. And I'll be honest, that moment really stuck with me. It showed exactly how powerful this can be, not just for the future, but for real life situations happening right now, every single day. People getting in a car accidents, don't know what to do with themselves. People going to long-term care. So this is the life insurance portion. So here's another common scenario. Most people, when asked to rate their confidence in their financial future on a scale of 1 to 10, most give a score in the mid range. This gap in confidence usually stems from a gap in understanding, not knowing how to make their money work effectively through every stage of life. That's why today I'm going to clarify that process. Every strong financial strategy is built on understanding three key phases: accumulation, protection, and distribution. So here we are in the accumulation phase on how money works. Benjamin Franklin said it best: money makes money, and the money that makes money. That is a perfect definition of compound interest. So, compound interest means your money earns returns not just on your original investment or principal, but also on all the growth it has already accumulated over time. Compound interest is like a snowball effect. Imagine a small snowball rolling down a hill. As it rolls, it picks up more snow, growing bigger, stronger, and more powerful with every turn. That's how compound interest builds wealth. To estimate the impact of compound interest, we use the rule of 72. You simply divide 72 by your interest rate. The result is the number of years it will take for your money to double in a 72-year time frame. So for this example below, it shows how much you can earn over time with an investment of $10,000 at different rates of return starting at age 29. So with 1%, this are like your savings account in a regular retail bank. You don't usually get a whole 1% at in your checking or savings account. But for this example, let's just start with 1%, right? So at age 29, he put $10,000 in his savings account. It will take him to he's 101 years old in order to double his money, $20,000. Now for the 4%, your money doubles every 18 years. The 4% are usually like your CD accounts, some high yield other savings accounts. You will get 4%. So at age 29, he has $10,000. By the age 47, he would double it by $20,000, and when he turns 65, he would double it by $40,000. Now the 6%, you will be doubling every 12 years. 6% are usually your life insurance policies, your index universal life insurance policy. So at the age of 29, he started at $10,000, and by the time he's 65, he was able to double his money 3 more times, which made him $80,000. And then we have our 12% interest accounts. These are like your annuities account. And some accounts is in the stock market, but you will lose your money in these accounts. But with 12%, he was able to double his money every 6 years. So that's the power of compound interest. And here is a crucial warning. Compound interest can work for you or against you. For instance, a credit card with a 23% interest rate will double your debt in just over 3 years if it's not paid off in full. Think about that. Many people are familiar with the idea of compound interest, but seeing it work with real numbers often changes your perspective. It truly is the engine of wealth, but it can also harm you as well. So this is the accumulation phase where you put your money to work so it can grow for you. So the second phase is the protection phase. So let's break down the three types of accounts in the protection phase. First, we have our fixed accounts. These include savings accounts, CDs, and credit union accounts. Your money is safe here, FDIC insured up to $250,000. But there's a trade-off. Interest is very low, often below inflation, so your money doesn't grow much. The bank uses your deposit to lend and invest, but your balance stays almost flat. That's why fixed accounts are best used for emergencies. You should have about 3 to 6 months of living expenses in your traditional bank accounts. They're generally accessible, though some banks have withdrawal limits on large sums. So, in short, fixed accounts offer safety, but they eliminate growth, meaning you're not in the accumulation phase with these fixed accounts. And remember, anything over $250,000 in one bank is not protected thanks to FDIC. So, a lot of people think because I have $250,000 in a checking account and then I have $100,000 in my savings account in this same bank, you only gonna be protected only for $250,000. That's why people move their money around a lot. Right? Next is our variable accounts. The second. These are market-based accounts like your 401ks, your IRAs, your 457s, and other retirement plans. They offer the potential for high returns, sometimes 10 to 12% or more in strong markets. But here's the catch. You also take on the risk of significant losses when the market declines. So while these accounts can grow, they do have the accumulation phase, but there's no guarantee your money will be protected when you need it most. It's a simple truth. People want the reward of growth without the reality of risk. A lot of people have these 401ks that's in the stock market, and then when a retirement comes, they loses all their money. Why? Because the stock market goes down. So how are they going to gain that money back? Third is the index accounts, one of our flagship solutions. These are designed to combine the best of both worlds. You get competitive returns, often ranging 6 to 9%, far better than a savings account and your fixed accounts, while your principal is protected even above the FDIC limit of $250,000. So if you have $1 million in an index account, you're not going to lose $1 million unless you take it all out and do something with it, gamble it or something. So you benefit when the market goes up in the index accounts, but you don't lose your principal when it goes down, and you maintain easy access to your funds. Index accounts provide safety, growth potential, and liquidity all in one place. So when you look at these three options, you might be wondering which one of these is the best fit for my money. The truth is, there is no single right answer because each account type serves a different purpose. The ideal strategy is often to use a combination of all three of these, letting your money work for you in different ways at different times. But if I had to choose one account for someone who wants to both grow and protect their money, the clear answer will be definitely an index account. It's designed to offer competitive growth while keeping your principal safe. Now, this slide is a visual summary of what we just discussed. A strong financial plan includes a mix of different account types because each one can serve you in different ways at different times. The right balance depends on your comfort with risk and your overall financial goals. So here on the far left side, here are our fixed investments, our checking accounts, savings accounts in a traditional bank, neighborhood bank. Your money there is safe, but your interest, you will not receive that much interest. May receive 0.25% to 2.0% or even less than that. Then on our far right hand side, these are our variable accounts, those accounts that's in the stock market, the 401ks, the 401ks, the TSPs, all these accounts, the retirement accounts. So you will get the benefit when the market is up, that upside potential, but you can lose all of that money at any time and go negative. So your money is not safe. You at risk of losing your money. And then in the middle is our index strategies where you have both the best of both worlds. You get the interest, you get the safety, you get the upside potential, and you will not lose any money. So now we are at the third phase on how money works, and that's the distribution phase. The amount of money you have and the financial vehicle you choose to use in the accumulation and protection phases will directly determine how that money is taxed when you need or want to use it. So let's look at the three ways money can be taxed. First, we have the tax now option. This works like a traditional W-2 job. You're taxed first, and then you use what's left over to save or invest. You can put it in a savings account, CD, money market, or a non-retirement investment account. Now, tax later, think of this like a piggy bank. You put the money in today without paying taxes, but when you finally break it open years later, that's when you pay taxes on what you take out of it. So this includes your 401ks, your IRAs, employer pensions, and other qualified retirement plans. And then we have our tax-free account. This is exactly what it sounds like. You pay no taxes on your growth or withdrawals. These are accounts like the Roth IRAs, your health savings account with it, which is the HSAs, municipal bonds, cash inside certain insurance policies, and executive bonus plans in companies. So to make your money work hardest over the long run, it should be in a vehicle that allows for cash accumulation, principal protection, and tax-free distributions. Since most people have tax later retirement accounts, I like to spend just a few more minutes going into more details about how they really work. So let's jump into it. So when it comes to retirement savings, about 90% of people use one or more of these accounts. So we have the IRAs, the 401k, 457, TSP, full 3AB, ESOPs, and deferred compensation as well. These are called qualified accounts, typically employee sponsor plans. Qualified means they meet IRS rules for tax deferred treatment. So you don't pay taxes now, but you will pay when you take withdrawals in retirement. But here's what many people don't realize. These accounts come with important rules and risks. So first, accessibility is limited until age 59 and a half. This can be both a blessing and a curse. It helps many people save because they can't easily tap into the funds. But if an emergency happens and you need money early, you face a 10% early withdrawal fee. Plus, you have to pay state taxes, which vary depending on where you live, and federal taxes, which could be 22% to 35% or more depending on your tax bracket. Now, let's talk about taxes at withdrawals. So, say you have $1 million in your 401k and you're over 59 and a half years old. You avoid the penalty, but you still owe federal taxes up to 35% and state taxes, typically 5 to 15%. So, that's 30 to 50% in taxes. 300K to 500K gone, leaving you with only 500 to 700K in your account for retirement. So all the rest of that money is being taxed during distribution. Then there are return minimum distributions. Starting at age 73, you must begin taking withdrawals out on your own. If you don't, the IRS can impose an additional 25% penalty on top of the regular taxes you owe. And there's another risk. Tax rates could rise in the future. Tax rates always rise, meaning you might pay even more later than you will pay today. So my goal is to help clients avoid unnecessary taxes and protect their savings from market losses. Now, imagine if you had a strategy to safeguard your retirement from both taxes and downturns. That's what we will explore next. Now, today I want to walk you through 3 powerful tax-free strategies that will protect your money and help grow your wealth as well. You pay taxes now on these accounts, and then you never have to pay taxes again. So first we have the municipal bonds. Think of a municipal bond as a loan that you offer to your city or state to fund public projects like parks, roads, or schools. The interest you earn is tax-free, which is the main benefit. The returns, however, are typically modest, around 1 to 2%, which often doesn't keep up pace with inflation. So while it's safe and it has a tax advantage option, there are usually stronger choices for long-term growth. But this is something that if you like, you should invest in. So then we have the Roth IRAs. So with the Roth IRAs, it's a market-based retirement account. It's designed for tax-free growth. You pay taxes on the money before you contribute. So all of your withdrawals in your retirement, including decades of growth, all are completely tax-free. So this is powerful protection against rising tax rates. However, Roth IRAs come with contribution limits. So if you're 49 years or younger, you are not able to contribute no more than $6,500 a year in this account. If you're 50 years or older, you cannot contribute no more than $7,500 in these accounts. And on top of that, you must qualify to have a Roth IRA. So if you're single and you make more than $139,000, you cannot get this account. And if you're married, you can't make no more than $206,000 a month. A year. If you do, they will not allow you to open up a Roth IRA or allow you to put any more money into this account. So the Roth IRAs are great accounts, but they do have limitations. So the government caps how much you can put in these precisely because they won't be taxed on it. They won't get the money from it. So for younger savers, it can be an incredible tool, but many people start too late or earn too much to fully benefit from an IRA. So, and then we have our IULs, the Index Universal Life Insurance Tax-Free Strategy. So this is where life insurance meets wealth building. An IUL is a flexible policy that provides lifelong protection for your family, offers tax advantage growth linked to the market indexes with downside protection. It includes living benefits you can access while you're still here. It's designed to grow cash value safely and effectively, while keeping your gains accessible and tax-free under current law. Now, we've been talking about the Index Universal Life and these policies, so I want to actually show you how this policy works. This is basically a 3-in-1 policy. You get 3 benefits of this policy. The IUL can be used for protection, emergency funds, retirement, college funds, and savings funds. But for this example, we're using the IUL as a life insurance retirement strategy. It's family protection with savings. So to start out with, a lot of people know about life insurance itself, the death benefit of life insurance. So, an example, this person has $200,000 of life insurance, the death benefit. So if he passes away, your family will get that $200,000 benefit. This policy also comes with living benefits. So, if you were to be diagnosed with a chronic, critical, or terminal illness, you'll be able to use this death benefit of $200,000 while you are still alive. So, that's the life insurance portion of this policy. Now, then let's go into the investment side of this policy. So, I do a consultation and I ask the person, how much money are you able to start this policy with? This person say $500. You don't have to start this policy with $500. You can start it with $200. You can start it with $100. Kids policy like $67, $100. So for this example, this person say they can put in this account $500 a month. Right. The premium to keep the policy open is only $60 a month. So the extra $440 and goes into what I call a savings bucket, which is actually the cash value. So in this savings bucket, the savings bucket is the interest is funded by a stock market index. So in this example is the S&P 500. There are also other stock market investments like the Dow, the NASDAQ, but for this it's the S&P 500. If you don't know what the S&P 500 is, it's basically tracking the top 500 companies performance. So they tracking Walmart, Amazon, and many others, the top 500. So, for example, we're using the S&P 500. Your money is safe because each account has a floor of 0%. So if the stock market goes down, the floor, you would not lose any money. But also, if the stock market goes up to 25-30%, you have a cap. You cannot make no more than 13%. In this account. Now, this is just for this strategy because we can actually change the index to where you don't have to have a cap. So whatever the stock market is 23%, you will get that amount. But for this example, to keep it simple, we're going to use a cap as 13%. Now, year one, you you have $1 million in your account. The stock market is up 10%. So all of your money that's in your savings bucket, you will receive 10% on that. Year two, the stock market goes down negative 12%. So in year two, you will not gain any money, but most importantly, you will not lose any money because of the floor. Whereas those people that's in the stock market, they are negative 12%, right? So they have to gain all their money back. Year three, the stock market is up 15%. So in year three, you would get that cap of 13%. You following me? We going from the S&P 500 chart to the years. And then year four is down negative 20%. Whereas year four, you would not um, gain any money, but most important, you will not lose any money. Whereas those people that's in the stock market, they just lost all of their money. They had way less than what they have. Because as you see, they was up 10%, then they went down negative 12%. So you negative 12% in the hole. You gain 15%. So now you 13%, 3% more than what you had 2 years ago. And then at that 13%, you now down 20%. So now that means that you bet negative 17%. Whereas with this index universal life insurance policy, you keeping all your money, no matter what. What's most important about this policy is that it's 100% tax free. So if you start taking distributions out of this account, it won't be taxed. If you pass away and your child, your beneficiary, receiving that $200,000, they would just get it in their bank account. It won't be taxed. There are tax codes that allow this to happen. There's so many tax codes, but this tax code 77002 states any money coming out of an insurance policy, for whatever reason it is, it cannot be taxed. So in that cash value, you can pull money out to purchase a home. You can pull money out for college funding, and you still will be gaining interest with all the money that's still in that account. So this is a powerful tool. And that's why understanding and appreciating the value of life insurance in itself is the first step towards unlocking this kind of growth. This is not for a person that's just trying to invest in something. This is not for that. You may want to use another tool for it, because you still should keep your money in this account so it can grow. That's what it's for. So the next few slides will show a hypothetical illustration of an index universal life insurance policy. This is for a 35-year-old male named John Smith. Key policy details: on the right-hand side, you'll see his annual premium is $6,000. That means he's paying $500 a month. His initial death benefit is $200,000. And he started his policy when he was 35 years of age. The first line where it says as he's 36 years old. As you can see, the policy value is $5,455. The cash surrender value, that if he decided that he want to close his account down at age 36, he will only get $915, not that $5,455. And his death benefit is increasing, so now it's $205,455. Now I want to explain to you how this policy works over time. So years 1 through 20, that means he had the policy for 20 years. This is the savings and the growth phase. John pays $6,000 per year. A portion covers the life insurance, and the rest builds his cash value. This cash value grows based on a market index like the S&P 500, but it is protected from market losses. There's 0% floor. At year 15, when he's 50 years of age, the policy value and cash surrender value meets up. That means if he decided to close his accounts, he will receive all of his cash, all of the cash value, not just a portion for closing. By year 20, at age 55, his cash value grows to $229,199. His total premiums paid from all the years that he had put into his account is $120,000, and this amount is the basis. Now, from years 21 and up, this is called the retirement income phase, the tax-free assets. When John retires, he can create a tax-free income stream using two simple methods. Tax-free withdrawals, he can withdraw up to his $120,000 basis at any time with zero income tax, or tax-free loans for growth. He can access the growth beyond his basis, that $109,199 without triggering taxes. He can use what we call policy loans. These loans don't require monthly payments. The balance is repaid later from the policy's proceeds or with interest. So you don't have to pay these your loan back. In the illustration, as you can see, you see negative numbers in the later years. This represents a combined strategy. He's withdrawing his basis and using loans against the growth to generate steady tax-free retirement income. The final benefit is legacy. The policy remains active, providing a reduced death benefit for his family. When John passes away, any remaining cash value and death benefit goes to his beneficiaries, income tax free. They don't have to pay any taxes on this money. The bottom line, the three benefits, and this is the three benefits in one plan: lifetime protection, a death benefit for his family. It is protected its growth, its market link gains with no risk of loss, tax-free retirement income. You get access to his savings through withdrawals and loans, creating a tax-advantaged income stream in retirement. Also, I must mention that your cash value can be used to purchase your first home, pay off debt, and for many other major purchases. It's your money. Do what you choose with it. Now, I would like to switch gears and talk about the great shift that is happening right now in our country. For decades, retirement rested on three pillars: Social Security, pensions, and personal savings. So let's look at the reality of each pillar today. First is Social Security. Studies indicate it may be diminished by 2038. It was designed as a supplement, not a primary income source, and its future is completely uncertain. Then we have pensions. The traditional pension is nearly extinct. Today, only 13 out of 100 Americans even qualify for one. That safety net is gone for most people, and many employers do not offer pension plans anymore. To take the funding off of pensions off the employer, they mostly all these jobs now has 401k, so you can fund them yourself. And then we have personal savings. This is where it gets personal. Data shows that 48% of Americans are living paycheck to paycheck without a pension and without a shaky social security system. The burden to save falls entirely on the individual, but nearly half the country can save. Or they don't know how to save, or they really can't save. So this is a great shift. The responsibility for a secure retirement has moved from the government and employers squarely onto the shoulders of the individual and the family. This is not a message of fear, but an urgent call to wake up. People are waking up to this reality every single day. They are looking for guidance, they're looking for education, for strategies that work, and sometimes it is too late to even start a plan. So here's a topic you've probably seen in the news. This slide is a collection of headlines from respected sources like Forbes and CNBC. Collectively, they point to what experts are calling a 401k crisis. Yes. So here are the main concerns that these slides are highlighting. First, high hidden fees. Forbes point out that many 401k plans have fees that are hard to find and understand. These hidden fees or costs are for management, for administration, and funds. It can easily and slowly drain your account over decades, costing you tens or even hundreds of thousands of dollars, and you don't even know about it. Second, vulnerability to market crashes. Look at the CNBC article. In 2022 alone, retirees lost 23% of their 401ks, their savings in their 401ks. There's no protection from downturns. Now, this is a scary reality of having your retirement savings directly exposed to the stock market, and the stock market always going up and down. And then third, the system itself is flawed. Perhaps the most striking quote here is from the inventor of the 401k himself, who has called his creation a monster. He says it was never meant to be the sole retirement plan for millions of Americans. It's like trying to use a tool for a job it was never designed for. Finally, the result is inadequate savings. The data is clear. Millions of Americans are reaching retirement age unprepared. Between market losses, fees, and a lack of guaranteed income, the 401k model has left many people anxious about their future. So, the big question is, if the traditional system has the risks and flaws, what's the alternative? A lot of people don't know. What else can I do? This isn't just about pointing out problems, it's about recognizing that we need a smarter approach for the distribution phase of our money. An approach that focuses on protection, guarantees, and a predictable income. Now, this leads us perfectly into our next topic that I want to talk about, and that is known as annuities. All right, so let's go into annuities. So first, I would like to say that annuity is not the type of an account. It is a strategy within a savings account held by a life insurance company. So to get an annuity, all you need is a lump sum of money. Qualifications doesn't go by your health history, medical records, or your mobility, and it does not have anything to do with life insurance itself. It's just the companies that specialize in annuities so happens to be life insurance companies. Annuities is like your own personal pension plan. So someone who has any type of medical history, you don't have to worry about it with an annuity. It's simply for retirement. This is simply a money to money transfer. So the process itself is much quicker in terms of approval than it is to basically actually qualify for it. So usually a person will have a qualified retirement account like a 401k, TSP, any type of employer accounts. And what they do is they transfer their money, their lump sum, into this a life insurance annuity account, which is actually a traditional IRA. So there are no penalties, and your lump sum is not taxed when it goes from one qualified account to another qualified account. And then the annuity strategy takes place within inside of this account held by the life insurance company. Some people have inheritance money. Some people have money that's saved up in their savings account, CDs. You can actually use that lump sum of money as well to open up an annuity, but it's going to be considered a non-qualified account. So it is not going to be taxed either. It's just helping track where the money's coming from, basically. So for this example, let's say we had Mr. Bob. Mr. Bob, he had transferred $300,000 out of his retirement accounts. He had 600,000. Let's say that he wanted to transfer just half of that, $300,000, into this account. Now, given today's economic climate, many companies are offering bonuses to new clients. These bonuses can range from 5% to as high as 24, 25%. So for instance, one company might offer a 10% bonus on day one just for you opening an account. So with another company may offer about 13%. So with this example, since Mr. Bob is transferring $300,000 over into this annuity account, he immediately get a $30,000 bonus, 10% bonus. Just essentially free money just for opening up an account. Once your money is in this savings bucket, it will grow based on the stock market indexes, but importantly, your money is not directly invested in the stock market. It's mirroring the stock market, just like the index universal life insurance policy. So this strategy guarantees your money will never decrease in value thanks to a floor of 0%. And just for this example, we will say 4 years, the average interest rate was 7%. So let's walk through a 4-year example of this index annuity strategy. So year one, the market grows 7%, you earn 7%. Year two, the market drops 12%, you earn 0%. No loss thanks to the floor. Year three, the market grows 4%, so now you have a 11% growth rate in your account. And how you get that 4%, that 11% growth rate is from year one, 7, plus the year 4. So that's equal 11. Then, I'm sorry, year 3. 7 plus 4 equals 11. Then we have year 4. The market dips again and you earn 0%, no losses. So in this strategy, what you do is you sign a contract with a life insurance company for a fixed term. Typically, it's for 10 years. I have not seen nothing for 5 years with an annuity. So during this period, your money grows, and at the end of the contract, you walk away with all of your money plus earnings, hence the name walk away annuity, or this is the accumulation annuity. The second option is to turn this into income for life, meaning you would never run out of money during retirement, guaranteed. And the life insurance company guarantees this. So, what if you need to access your money during the contract? First of all, I would like to say that this is a set it and forget it strategy. Unlike some other plans, it's designed to grow without withdrawals. However, there is some flexibility. So after the first year, you can access 10% of your funds, 20% after year 2, increasing by 10% each year. So by year 7, you can withdraw up to 70%, and then year 10, which is a contract, you can withdraw all of your money. Now, if you are anticipating and needing the money sooner or regularly, this may not be the best fit. Think of this more like an advanced high interest earning CD account. So, you will receive an annual statement showing your growth on this account. And you can also have online access where you actually look at your account as well and see the growth. So in summary, with this account, you can get a generous initial bonus if that's what you choose after seeing some options for you. You will get competitive annual interest credits, 0 risk of loss due to the floor, no management fees, the ability to walk away with all of your money plus earnings at the end of the term, or turn on income distributions for life. So this is an example of an annuity. So now I'm going to show you how this works in a real life example. So Mr. Bob, he's 55 years old and wants to protect some of his retirement money from market losses. He transfers $300,000 from his 401k into an annuity, right? So He selects an option with a 25% bonus designed to maximize his future income potential. So, based on the projected average interest rate of 7%, his income base grows to approximately $735,000 over 10 years. At age 65, Mr. Bob turns on his income. So he begins receiving $38,220 per year, guaranteed for life. If Mr. Bob lives for the next 25 years to age 90, he will have received a total of $955,500 in income. If there is any remaining balance in his account at the time of his passing, up to $735,000, that money goes directly to his beneficiaries. So, unlike a traditional employer pension where unused funds may revert back to the company, this strategy allows you to create your own personal pension plan while maintaining family protection. That's the power of an annuity. Now, let's take a look at how this type of annuity actually grows before you ever turn on income. This is what we call the accumulation phase, or sometimes the walk away phase, because this is the period where your money is growing and you still have the option to walk away with it later. So, this example is a hypothetical illustration from a Thing insurance company using the Performance Elite 10 annuity product. So let's go back to Mr. Bob. He starts at age 55 and he decides to move $300,000 into this annuity. So right away, he receives a 12% bonus, which adds $36,000 on day one, bringing his starting value to $336,000. Now, after just 1 year at age 56, his account grows to $363,720, which includes both his accumulated value and the death benefit. Now, I want to pause here and explain something very important. An annuity, again, is a contract with the insurance company, and in this case, it's a 10-year contract. So if Mr. Bob decides to exit the contract early, let's say after just 1 year, he would not receive the full accumulated value. Instead, he will receive the surrender value, which is in this example is $285,780. That's because these types of strategies are designed for long-term growth, not short-term use. But if he allows the money to stay and grow, by age 65, after 10 years, his account value increases to approximately $633,523. Now, here where it gets even more interesting. If Mr. Bob decides not to touch the money yet and let it continue to grow for just 3 more years, his value increased to $803,612, including his accumulated value, surrender value, and death benefit. It's all the same. So now let's talk about how the growth actually works, because this is one of the most important parts. So, this annuity is tied to the market index again, which means your returns are based on the market performance. However, it comes with a cap. In this case, it's 8.25%. So, in years when the market performs well, Mr. Bob can earn interest up to that cap, 8.25%. But in years when the market is down, his returns may be 0%. And this is the key advantage. He does not lose money due to the market when the market declines. So even in a bad market year, his account value is protected. It's staying the same. He may not gain that year, but he also doesn't go backwards as well. He still have all his money in his account. And that what makes this strategy so powerful for people who are getting closer to retirement. It gives you the opportunity to grow your money while also protecting what you're already built as well. So now I had went over 4 different ways of how we are able to help people um, with our life insurance policies, with annuities. So now I want to go into more details and give you more information about your financial independence and how we are able to help. So this slide outlines our proven roadmap, the 6 steps to financial independence. This isn't just theory, it's the practical sequence we use to help clients build and protect their wealth. So let's walk through them. Number one is cash flow. It all starts with understanding your money. We look at how to increase your income and smartly manage expenses so you have more money working for you, not just going out the door. The emergency fund. Before any investing takes place, we ensure you have a safety net. This is 3 to 6 months of living expenses set aside in a safe, accessible account so an unexpected event doesn't derail your long term plans. Then we have debt management. High interest debt is a wealth killer. So we develop a strategy to consolidate and systematically eliminate debt, freeing you up cash flow for building wealth. Then we have the proper protection step. This is the foundation. We make sure you and your family are protected against major financial risks. This loss of income is due to death, disability, or illness, and that your assets are safeguarded. This is where life insurance and living benefits come in with the proper protection phase. And then we build wealth. Now we focus on growth for the most part when we build wealth. We implement strategies designed to outpace inflation and minimize taxes using professional money management principles. This includes the index and protective strategies we've discussed earlier. And then we want to preserve wealth. Finally, we plan for legacy. We look at strategies to reduce taxation on what you're built and to create a lasting financial legacy for your family. This is a sequential, disciplined process. You can't effectively build wealth in step 5 without first having protection in place. Step 4. And you can't preserve it in step 6 without a solid plan to build it. So our role is to guide you through each step, providing the education and strategies tailored to your unique situation. So we can discuss the steps to financial independence with a follow up on the resources that you can use and the companies that you can use to help you with debt management. So now I want to get into some fun facts. So for fun fact number one, who do you think is the number one purchaser of life insurance? You may not even believe your eyes when I show you the next slide. Who do you think is the number one purchaser of life insurance? There you go. Banks. Banks. So you can look this up yourself. So the banks ranked by life insurance assets. The following is a ranking of all banks in the United States in terms of life insurance assets. This comparison is based on data reported on September the 30th, 2025. And the number one ranking of banks who purchase life insurance is Bank of America, followed by Wells Fargo, followed by JP Morgan Chase Bank. So the purpose, banks invest in high cash value permanent life insurance to hedge the cost of employee benefits such as health insurance and retirement plans. For many large banks, these policies represent a significant portion of their non-interest earning assets. And these figures are typically reported in bank filings with the FFIEC. So there you go. Banks. Using your money, and you can actually become your own bank. That's another class that I probably teach next. using life insurance, these life insurance policies. All right. Fun fact number 2. How Social Security survivor benefits funded and how Social Security retirement benefits funded. So the Social Security survivor benefits are funded when a person dies, and the retirement, Social Security retirement benefits, how are they funded? What do you think? Think about it. And here we go. So, Social Security survivor benefits is like a life insurance policy, and the Social Security retirement is like an annuity. So the survivor benefits, Social Security provides a form of life insurance protection for families for a young worker with children. These survivor benefits can be equivalent to having a $476,000 life insurance policy. Usually survivor benefits is when someone passes away, they have Social Security, and it goes to their children up to the time they turn 18. Retirement income, the Social Security retirement income is functions like a government provided annuity, offering a guaranteed monthly income for life that is protected against inflation through annual cost of living adjustments, a feature rarely found in private annuities. So there you go. The government used policies, life insurance policies as well. So now that you understand how money works and the different policies that are available, the next step is simply deciding what type of solution you'd like to explore for yourself and or your family. So I work with several strategies depending on your goals, whether that's basic protection, building cash value, or creating retirement income. If something I explained stood out to you the most, just text the number that corresponds with the option you're most interested in. So, text number 1 for term life insurance is affordable protection for a specific period of time. I actually consider getting term life insurance policy just like a safe haven. Like to use while you're still living. So if something were to happen, just like car insurance, if something were to happen, I will liquidate it. That's what I'm basically looking at term life insurance for, right? Okay. Text number 2 for whole life insurance. For whole life insurance policies, it's a permanent protection that builds cash value. Text 3 for index universal life. It's protection with the potential to grow, tax advantage, cash value, all that good stuff. And text 4 for annuities, strategies designed to create protected retirement income for life. Once I receive your text, you'll get a reply with a link to schedule an EPA. An EPA is an expert financial analysis where we'll review your goals and see what options fit you the best. So the next meeting is basically just getting all your finances together, going over key points of this masterclass, clarifying any slides that you have questions on or want to go over again. So again, text the number that's on the screen and you will receive a link to schedule a EPA. And lastly, I just wanted to take a moment to personally thank you for taking the time to tune into this financial literacy masterclass. My goal is always to make sure you walk away with a better understanding of how to protect your income, grow your money, and build a stronger financial future for you and your family. If something you learned today stood out to you, I encourage you to take that next step and put a plan in place. And also, if you know someone, a friend, a family member, a coworker who could benefit from this same information, please feel free to share this masterclass with them. Scan the QR code on my screen and bookmark the link so you can be able to send it out to them. Once they register, they will be able to review the same masterclass and also schedule time to connect as well. And of course, All of my contact information is here on the screen as well, so don't hesitate to reach out if you have any questions or if you're ready to get started. Again, thank you so much for your time, and I look forward to connecting with you soon.